And now we look at the short-run demand for labor and the perfectly competitive seller. Last time I was just trying to explain to us that what short-run means is basically the period when at least one factor of production is fixed. That's what we explained. But in the long run, all factors of production are variable. They change with time. And the perfect competition just describes that market where, you know, uh, there are many buyers, there are many sellers, no participants have power over prices, all firms are price takers. Um, it is if you have so many buyers, so many sellers, and again, the commodity that we are selling is the same. That is in the perfect competition market. Information is free, and in perfect competition market, um, there are no barriers to entry. Anybody can just move in and just join that market. Now, what determines the hiring decision, or how are the decisions about hiring made? Um, Hiring people, of course, in economics, right? Employing. We do know that profit maximizing firms will only hire an additional worker as long as each worker adds more to revenue than she costs. Before you employ somebody, you ask yourself the question, how much is their contribution compared to the costs? Because you can't just keep on employing people. You employ more people than it costs you. You find that the costs may be higher than, the benefits you are getting from the employment of such an individual. So you want to make sure that the people that you are hiring, their contribution, is more than their costs. Now, that ushers us into the conversation marginal revenue product, which is basically the change in the total revenue because of hiring an additional worker. So the marginal revenue product is basically that change in total revenue, right? Our total revenue shall change. Why has the total revenue changed? It has changed because we have added another worker. We have hired another worker. All right. So now the marginal revenue product, therefore, will be basically marginal revenue multiplied by the marginal product. Multiply these two, and you have the marginal revenue product. So the marginal wage cost, therefore, is basically the change in the total costs of wages because of hiring an additional worker. It's not just revenue that is adjusting or that is increasing. Also, the cost is increasing from the other end. And so, if the cost has increased because of one person that we have, because of an additional worker that we have employed, that shall be called the marginal wage costs. Output or revenue has increased because I have an additional worker, that is marginal revenue product. Now, the hiring rule is we will hire additional workers until the point where the marginal revenue product equals marginal wage costs. That is the rule. Please remember this rule. We'll use it even to do calculations. It's a rule. You can only hire up to a point where marginal revenue product, the additional contribution of each worker to the revenue, is equal, to the additional costs. All right? The additional costs as a result of the new worker employed. So basically, that is the limit. Now, we do know that in the short run, of course, you can calculate for marginal product. You know that marginal product is calculated by saying change in total product divided by change in labor. That's marginal product of labor. I'll repeat. Change in total product is basically total product 2 minus the total product 1 divided by labor unit 2 minus labor unit 1. This is the formula. So if you are given total products, the list for total product and for units of labor, to find the marginal products, MP, you just difference a higher marginal product. The first ones are 0, 0, for example. At 1, you say 5 minus the previous one is 0. 5, that's the total product. 5 minus 0 divided by the labor units are 1 minus 0. That shall be 5 divided by 1, so that you can have 5 as a marginal product. I guess you're following, right? That's a change in total product, basically, which is same as TP minus TP1 and the L2 minus L1. Then for the next one, you say 9 minus 5. You're following, right? 9, which is total, a higher total product. 9 minus 5 divided by, 2 minus 1, that gives you 4. That's that. 9 minus 5 is 4 divided by 2 minus 1, which is 1. 4 divided by 1 is 4. And the next one will be 12 minus what? Minus 9 divided by 3 minus 2, which is 3. All right. You have that. 3 minus 2 is 1 into 3 is 3. And then this other one will be 14 minus 12, which is 2. 15.5 minus 14, 1.5. 16.5 minus 15.5 is 1. 17 minus 16.5 is 0.5. So that's how you come up with the list for the marginal product. It's basically the change. It's marked as the change in total product. I don't know how true this is. This is mathematically, by the way. Someone told me that you will not be examined on the use of calculus. And I want to just confirm that, because you can still do this using calculus. You can apply higher order calculus and derivatives here to represent this same relationship. Is there any need of showing this using calculus? What did your lecturer guide you? Let me just get confirmation. Someone told me that there will be no calculus. Is that true? You can just feed me with data, or someone you are not aware. You don't know.
I'm not aware myself. I think I've missed a number of his classes.
I don't know. Everybody is missing in here. Nobody was there. Only that person who fed me with this. Now, how bankable is that? No one is confirming it. I don't know. But someone told me that there will be no much of use of calculus, which means you use normal numbers like this. But if you're using calculus, by the way, if you're given a total product equation, if it's the use of calculus, right, you need marginal product. Then you have to differentiate the equation. For example, you have given 2q squared, minus 3q, maybe plus 5. This is a total product function. So what you do is, to find the marginal product, just differentiate this with respect to x. Apply differential calculus. Differentiate, find the first derivative of that. That's how you work with this and start substituting these units into that. And it will give you these numbers. That's how you use calculus. But we will not really dwell much on the use of calculus. Okay. Anyways, so now we have the sales price and the total revenue. Total revenue is basically, found by saying sales times what? Times the price, isn't it? Sales price times the units. Basically, it should be the units times that. All right? So, if you could have 5 multiplied by, 5 multiplied by 2,000, that's 1,000, or 5 times multiplied by 200, and 9, the marginal product, which is the total product times the price. 9 times 200, that gives us 1,800. We are finding total revenue. 12. In short, total product multiplied by the sales price gives us the total revenue. Okay? Total product times the price, the sales price, gives us the total revenue. That's how we find the total revenues. Now, you want to find the marginal revenue product. Marginal revenue product. Quite interesting. Marginal revenue product shall be found by saying the change in the total revenue. Look, change in the total revenue divided by the change in the labor. Total revenue is changed by saying total revenue 2 minus total revenue 1 divided by L2 minus L1, right?
Yeah, actually,
So
this
that
is
is you're saying a higher total revenue. Let me just try to mute the gentleman. Okay. So we are saying that the higher total revenue in our case is 1,000, right? 1,000 minus 0, okay, it gives us what? It gives us 1,000 divided by the labor here is 1 minus 0 as well, which will be 1,000. That's how you find this marginal revenue product. Because sometimes maybe a lecturer can just bring in a table like this and leave others and tell you to finish up. I complete the table. You should know how these answers are found. So to find the marginal revenue product, you could easily do that. Or for this second one, for the second unit, you can say 180 minus 1,000 divided by 2 minus 1, which will be just 800. Yeah? Then for the third one, we say 24 minus 18, 2,400 minus 18, that is 600. Okay? Then 28 minus 24 divided by 4 minus 3, that gives us 400. Okay? And the 31 minus 28 gives us 300. 33 minus 31 is 200 as well. 34 minus 33, that gives us 100. That's how you come up with the marginal revenue product. Okay. Is there any question on how you come up with the marginal revenue product, how you come up with total revenue, and how you come up with the marginal product? These three. You know how to come up with them, right? These, you come up with them. Okay. If we have understood on how to come up with them, then that's fine. We can just proceed.
Yeah, I think for me, I joined the class a bit late. Maybe I wouldn't love to take you back. I'll just maybe ask you to share the recording from my start from the beginning.
No problem. I will make sure that before 9 hours you have it tomorrow. It will be there. Now, the value of the marginal product is basically the extra output. Okay, of course, in current terms, in terms of our kwacha, we can say in kwacha terms, that's the society gains when an extra worker is employed. So the value of the marginal product is basically the price multiplied by the marginal product. This is very important for you to take home. The value of the marginal product, right? Marginal product is just the additional output, like the total output that comes because we have employed an extra person. It is given by saying the price multiplied by the marginal product, and of which the marginal product I showed you how to find it previously. So you have to use that. For a perfect competitive seller, marginal revenue is equal to price. That is very important. Because of that, then value of marginal product is equal to marginal revenue price. Marginal revenue product is the same. That's what we mean under perfect competitive for firm. If it's a perfect competitive firm, then marginal the value of the marginal product, okay, is equal to the marginal revenue product. Marginal revenue product. Okay. Anyways, so basically that's that. When you talk about the imperfect market, I think we understand the imperfect market, that here, this is where the monopoly market, where there is only one firm that is producing and selling to everybody. Oligopoly, this is where very few firms that are producing goods. Monopson is where there is only one buyer of a good. Yeah. Oligopson, this is where there are few buyers of a good. That's very important. So monopson is not really a market. This is a situation where you have only one buyer of a good, not one seller. Monopoly is one seller, one seller of a good. But monopson is one buyer of a good. That's a difference. You need to understand the difference. And the oligopoly is when there are just a few sellers, maybe 1, 2, 3. Like for Zambian telecommunications, you just have Airtel, Zamtel, and what is that one? MTN, eh? Maybe just 3 of them. That's oligopoly market. But oligopson, this is where you have very few buyers. Like the buyers themselves are just few. That's oligopson. Okay. This is the same thing about I think I will not start repeating again on how you find the marginal product. This is the same thing I said previously on how to find total product and how to find the marginal revenue product. It's the same way, same calculations as we did in the previous slide. Okay. Now, the concept that is very important to take home is the concept of substitution effect. Now, substitution effect is the change in employment resulting from a change in the relative price of labor. Yeah, of course, if you hold other factors constant, like the output. Employment has changed, okay, because the price of labor, in other words, the wages, right? The salaries have changed. That is called the substitution effect. The change in employment, that is because of the change in the wages, okay? Then you see employment changing. That is the substitution effect. If you see a decline, for example, in wage rate, like the wages have decreased, then the firms will just substitute labor for the now relatively more expensive capital. If it is cheaper to work with people, you will see that they'll employ more people. All right. But again, when we have the opposite, the wages have become high, the people are expensive, we'll replace people with machines. Okay. We just work with machines. All right. So basically, that's really what does happen, right? What are some of the other factors to consider? We said that demand is affected, of course, the demand for labor, by so many other factors. For example, the demand is more elastic in the long run than in the short run. To be elastic simply means to be more responsive to changes in wages. The demand is very elastic, is very responsive. So what you will see is that in the long run, the demand the product demand will be responsive to wages change as compared to the short run. So because the demand of the product is elastic in the long run, even the demand of labor will be elastic. We told you that the demand of labor is a derived demand, yeah? It's a derived demand. It derives its value from the product, from the demand of the product. So even the elasticity, if the elasticity of the product, for example, is elastic, then also the demand for that labor will be elastic, because this demand is never independent. The demand for labor is never independent. It's linked to the demand of a product. So that's the message that we actually sent, and we are still sending that. A bit about technology, of course, is also one of the factors affecting demand. So if wages, for example, fall, then technological, innovators will try to reduce the use of capital and increase the use of labor, because the labor is cheap. Labor is cheap. Then we can use more of labor than capital. That's what really happens. So very important to take that home. Now, market demand for labor, the demand for labor is basically the consolidated demand, just like the one that you deal with under the normal product one. The other part of the conversation that you can easily be examined is that of the elasticity of labor demand, basically. Yeah, I think we have had so many conversations, but I'll still talk about it on elasticity of labor demand. Now, elasticity of labor demand is basically the responsiveness, all right? The responsiveness of the quantity of labor demanded to the wage rate or to the changes in wage. That responsiveness shall be called the wage elasticity, all right? That will be the wage elasticity. Very, very important. So wage elasticity coefficient, therefore, is basically just corresponding to the price elasticity of demand. They are just in correspondence, and that's why you've seen even the formula that is used is the same. This is the arc elasticity of demand. It is done like this as well. Only that where there is price, they put wage. You've seen, eh? Arc elasticity of demand, the change, you say Q naught minus Q1, divided by P naught by P1. That is if you are dealing with the product. But since you're dealing with wages, where there is P, you always put wage. It's the same message that we are saying. Wages, the same elasticity of demand, Q naught plus Q1, basically that and that. So this is a formula that will give you to find the wage elasticity coefficient, and that is how it is found. It is called the arc wage elasticity coefficient. It's not the point. It's not the point wage elasticity coefficient, but instead it is the arc one. All right. It is the requirement of your notes that we talk about what determines the elasticity of demand as well. What really factors determine that? Or what factors? Number one, it is the elasticity of the product that is demanded, because we said that the demand of of labor is derived from the demand of the product, and so is elasticity. Elasticity of labor is dependent on the elasticity of the product that you're dealing with. That labor, the elasticity of the product that the labor is used to produce. So if you find that the price elasticity of product demand is great, then the elasticity of labor demand will also be great. They move in the same direction. So when you check, there could be some firms that have some market power. These will tend to have more inelastic product demand. Yeah, because they have power. And then their labor demand will also be inelastic because they have market power. Like the firms themselves, they have that market power. The responsiveness will not be very much. As we highlighted in the previous slide, maybe we could just say it again, that in the short run, demand is more elastic. Oh, sorry, is less elastic as compared to being to in the long run. Right? In the long run, after a long time, the demand is more elastic than in the short run. I'll repeat. The product demand is more elastic in the long run after more time has passed. Why? Because more time has passed and people are willing to make adjustments. Then, because the product demand is more elastic in the long run, the labor demand as well is more elastic in the long run because they move in the same direction. This is what I've said. They move in the same direction. So if the product demand is more elastic in the long run, it means that also the labor demand is more elastic in the long run. And that's a message you should take home. Okay? Then the other factor that affects elasticity is the ratio of labor cost to total costs. In other words, how much, is the share of labor costs in the total costs? So if there is a lot of cost of labor in the total cost, then the elasticity of labor demand will be high. So let me explain it in this way. When you look at the total costs that you are incurring as a company, for example, you ask it, out of this total cost, how much of it, how much of this total cost is as a result of labor? How much is spent on wages? All right. For example, you could see that if you have a 10% increase in wages, that is in labor accounts. So for 10% of total cost, then it will rise maybe the total cost by just basically 10%. That's what we mean. Like if it's 10% increase in wage, in the labor costs or the labor cost accounting, which is just for the 10% of the total, then that simply means the total cost rises only by a lower unit. Yeah, just by that. But again, it's possible to have, the opposite, where the 10% rise in wages in labor account, for example, for 50% of total costs, will raise the cost again by 10%. So in short, the total cost will be increasing as the wage is increasing. Then the question of the day is, how much out of that total costs is as a result of the change in labor? The other factor that determines elasticity, you should be able to remember the factors, substitutability of the other inputs. Like, can you substitute, if the substitutability of these other inputs for labor is greater, then the greater will be the elasticity of labor demand. You will see that the elasticity will be greater. And what do we mean by greater elasticity? We mean elastic, it will be elastic. Because you can easily substitute the inputs for labor. And so the responsiveness of firms will easily respond to changes in wages. Because they can easily substitute labor. You get what I mean? Yeah, so that's one of the factors that affect the elasticity of demand. And the supply elasticity of other inputs. That is to say, how much of these other inputs that are actually supplied. So now, I think I should go over this quickly again. The determinants of elasticity. I said it is number one determined by the elasticity of the product that is being demanded. If the product being demanded is more elastic, then it means also the labor demand will be more elastic. Two, the percentage of the labor cost in the total cost and the substitutability of these other inputs with labor. And finally, the supply of elasticity of other inputs. So basically, that's that. What determines labor demand as we conclude the conversation? Labor demand now is determined by what? Number one, product demand, because I told you that labor demand is a derived demand. It is not demand on its own. So what it determines is the product demand. If the product is on high demand, also the labor demand, that labor which produces that product will be on high demand. Number two, the productivity of that same labor. If that labor is, very productive, okay, then you will see the more demand for that. A number of employers. If you keep other factors constant, ceteris paribus, then a change in the number of firms employing a particular type of labor will change the labor demand in the same direction. Yeah. If you have more firms that are employing, then more people will be demanded than they'll be employed in that particular. And also the prices of other resources, like maybe labor, let's say, to simplify the conversation, labor versus capital. Which one is more expensive? Should we use machines or labor? Which one is more expensive? So if you look at that, if you find that maybe capital is less expensive than labor, we'll go for capital. I mean, why not go for capital? Because we're a profit-making organization. Yeah, so this is basically the conversation around all this stuff. Nothing much, nothing little.